Okay, so basically the purpose of this webinar today was to ascertain the impact of UAE corporate tax on Indian companies as well as individuals with UAE businesses. So we discussed this particular topic when the draft public consultation document was issued. And I thought with the change of law, with the detailed law being issued, it would be good to maybe look up at some of those concepts, because one thing that has happened is quite a few of the things which were there earlier seem to have been clarified in much more detail, and therefore the implications on different set of people, different set of companies who are operating is something which is more clear now compared to what it was earlier. So we will go through this one by one. Please bear with me for a minute. So basically, when we talk about the UAE corporate tax regime, we had the draft public consultation document that was issued on April 28, 2022. And now we have the corporate tax law, which has been issued in October, even though it was publicly available last week itself. But the provisions of this law are effective from June 1, 2023. When I say June 1, 2023, it basically means for financial year commencing on or after June 1, 2023. The rate of corporate tax, which has been specified, will depend on two things now. So earlier, the rate of corporate tax that was there was 0% on taxable income up to AED 375,000. Now, in the new law that is been issued, the amount up to which this income will be exempt has not been provided. So basically, they've mentioned that up to specified income. Now, what is the specified income? That is something which one will need to wait. The second is the rate will be 9% on taxable income exceeding above AED, the specified limit. Now, the limit that was provided earlier was actually close to $100,000. It was around AED 375,000, which translated into $100,000. Now, globally, if you see, this limit was quite on a higher side, because generally the exemptions which are available are on the lower side compared to this particular number. And therefore, there's a relook that might happen probably for this number, depending on how the guidelines are issued. Now, what will be the specified income below which the income will be exempt or above which the income will be taxable? That shall be issued through a cabinet decision, considering the suggestions of Minister of Finance. Now, when we talk about these tax rate, these tax rates are basically applicable for people other than free zone. For free zone people, we've just covered the tax rate in the next slide, because that's slightly different compared to what we have right now. So for a free zone person, a qualifying free zone person, there's actually a definition where this term qualifying free zone person has been clearly amended in terms of what are the criteria that has to be met before a person will qualify as a qualifying free zone person. So if a free zone entity or a free zone person meets the criteria of a qualifying free zone person, the tax they have to pay is 0% on certain qualifying income. So two conditions: one, the person has to be a qualifying free zone person. Second, they have to earn qualifying income. Now, what is qualifying income? That is not clear in as many words as of today, but we do expect that this point will be clarified as more things are released. But for a free zone person, the tax will be 9% on non-qualifying income. So if a person does not qualify as a qualifying FZP, or they qualify as a free zone person, but they do not have qualifying income, the rate of tax will be 9%. Now, Unlike, the draft public consultation document where the concept of a taxable person was divided between, different categories of people like natural person, legal person, and then there was certain exempt person. The criteria of taxable person under the UAE corporate tax law is now based on residential status. So it basically deals with and says that a person can either be a resident or a non-resident. Now, there are various criteria as to when a person would qualify as a resident person. So, for example, a company which is incorporated or registered in the UAE, typically referred to as the juridical person in the UAE corporate law, is something which is going to get qualified as a resident. Secondly, a natural person, an individual who basically is conducting business activity in the UAE, may qualify as a resident. But when we look at it from an India perspective, because that's the topic of discussion today, the Indian company whose management and control is in the UAE will also be deemed to be a UAE tax resident. We have an example for this in the next slide, so we will discuss it in detail there. For a non-resident, the income that is going to get taxed is the income which is attributable to the PE, income which is classified as UAE sourced income. So there's a detailed article on this particular part which defines state sourced income. That is going to be the UAE sourced income or income that has nexus with UAE. So for a non-resident, these three are going to be taxable, whereas for a resident, their income from activities within and outside UAE will be taxable. Of course, there could be certain exemptions for a specific type of income, which can be considered. Now, most of these resources that we are covering as a part of this particular presentation are also now being updated on our UAE corporate tax page, which is sortingtax.com/UAE corporate tax. And basically, you can see a lot of, if I just go, there are a lot of resources that we have on our website. So you've got the UAE corporate tax course, and then you've got various resources which are available for you to read out from. So whenever you feel like, you can just go and access many of these resources on our website. This is the particular URL where everything relating to UAE corporate tax is there. And if I just show it to you, it seems, so this is the page that we have created for UAE corporate tax, where we are regularly updating all our findings on the UAE corporate tax, whatever presentations, etc. we are taking. The material relating to that is something which is uploaded here as well. If you ever, after the presentation, or are looking out for content relating to the UAE corporate tax, we are updating this on a chapter to chapter basis. Now, coming back to our presentation, I said that, from an Indian company perspective, deemed UAE resident. So an Indian company can also be deemed to be a UAE resident if the control and management of this company is in the UAE. Now, when would that happen? So let's take an example here. Suppose there is a company which is incorporated in India. Okay. It has certain UK shareholders, right? And it has certain UAE shareholders. Now, EFCO is incorporated in India. EFCO has 5 directors, of whom 4 are permanent tax residents of UAE. So 4 directors are tax resident of UAE and 1 is, let's say, in UK. The directors conduct majority but 1 board meeting in the UAE. So all the board meetings are also conducted in the UAE, which is the majority of the meeting. 1 meeting is not conducted there, but otherwise majority of the meetings are conducted. And important strategic decisions in respect of UAE corporate, in respect of the foreign company are taken in the UAE. EFCO has a general manager in India who looks after the day-to-day operations in India. Now, when we talk about control and management, generally the criteria of control and management is basically one of the important criteria is where the board of directors sits and takes the majority of decision. In this case, because 4 out of 5 directors are based out of UAE and they are sitting there and taking decisions, therefore, what is happening is that the control and management is actually in UAE. In such a case, this company, EFCO, even though it is incorporated in India, right, it will be deemed to be a resident of UAE. Now, many countries have threshold in terms of, when all these regulations are going to be applicable. If those threshold comes out, that is something which one will need to watch out for. The implication for this is that the income earned by this company, which is deemed as a resident of the UAE, will be liable to tax in UAE. Let's look at the taxation of individuals. So insofar as an individual is concerned, if they are having an employment in the UAE, so let's say X is a person who's employed with UAE LLC. He's working in UAE and drawing salary from the UAE. In such a case, the income that he earns in the UAE will be exempt from the applicability of corporate tax. However, if X is also a tax resident of India, so let's say, for example, in a particular financial year, X was in India for 200 days, and for the rest of the days, he was in UAE. In such a case, if X is a resident of India as well as UAE, in that case, you'll need to see the provisions of the tax treaty to see how the taxability is going to arise. Interest income earned by an individual, dividend or rent, capital gains, all will be exempt under the UAE corporate tax. But the exemption for this, and this will depend on whether these are earned by them as a business or these are just simple activity that they are doing. If a person who is an individual, who's a resident of India, conducts business activities in the UAE, then the income relating to the conduct of such business will be liable to UAE corporate tax. The income might be earned in the UAE or outside UAE. But such a person will qualify as a resident and his such income will be taxable. So business income, not the other income, but only the business income relating to the business conducted in UAE will be liable to UAE corporate tax. And this is very, very important because what happens is that there are a large number of individuals who actually sit in India and they do business in the UAE. So they do have one or two few people in the UAE. The rest of the people are sitting in India and they are conducting businesses. If it's in the form of a legal entity, then obviously this provision is not applicable. The foreign company provision, which we are going to discuss next, are the ones which are going to apply. But if the person is doing that business in individual capacity, then that will be liable to UAE corporate tax. Of course, if an individual who's liable to tax in India also pays UAE corporate tax for the sole proprietorship individual business, then whatever taxes are deducted in the UAE. So currently the withholding tax seems to be 0%. And the 0% is also in respect of only certain specified incomes. But if there is any withholding tax which is done at a later date or specified, then that will be available as a credit to the individual while filing their tax return in India. Now, in order to ensure that small businesses do not suffer from the UAE corporate tax, there is a particular article which has been provided in the UAE corporate tax law, which says that a resident taxable person, if he is an exempt person, then this is not applicable because in any ways he doesn't have to pay tax, may elect to be treated as not having derived any taxable income for a tax period. So where revenue in that tax period and previous tax period does not exceed a specified threshold. Now, what this means here is, this is important to understand, is that if the revenue either in the tax period or in earlier tax periods exceeded a specified threshold, then this relief is not applicable. So the way it seems is that if in 1 year it increases beyond the specified threshold and in the second it is not, then the relief in this year will also not be available. Once you exceed this limit, then this is not going to be available. Now, the only important question that one needs to see is, we're talking here about the tax period. So does it mean that once the corporate tax law becomes effective, it is only in respect of those periods that we are going to apply and see this criteria? Now let's look at taxation of foreign companies, and the purpose of this foreign company thing is only with respect to India. So an Indian company will be liable to tax in the UAE in respect of income which is attributable to a permanent establishment in UAE. Now, the definition of permanent establishment is given in Article 14 of the UAE Corporate Tax Law. One thing, however, which is important is that there is also India-UAE tax treaty. And under the UAE Corporate Tax Law, it is proposed that it is actually a provision now no longer proposed, that if there are any international agreements, the provision of those agreements will override the domestic UAE Corporate Tax Law. So first thing is you need to see if the PE exists as per the tax law. If it does not, the matter ends. If it does, then what you need to see is whether under the provisions of the India-UAE tax treaty, a permanent establishment can be said to exist. If the answer to this again is a yes, then this income attributable to the UAE PE will be liable to UAE corporate tax. But if the answer is that no, this income is not resulting in any PE, then there might be an exemption, provided the income does not fall under any other clause. This is again a new concept of state-sourced income under Article 13. So basically, there's a list of income which have been specified to be constituting state-sourced income and therefore liable to UAE corporate tax. Now, some of these we are going to discuss in the next slide. And any income that has nexus to the UAE, which is specified in a cabinet decision. Now, when we talk about UAE sourced income, basically Article 13(1) says that income derived from a UAE resident will be considered as UAE sourced income. Now, this is a very, very broad term, right? So that means that if there is a UAE resident, and resident can be a natural person, a company, or a foreign company which is deemed as resident. If there's any income arrived from this resident person, right, then that derived by an Indian company will be liable to UAE corporate tax. The second is payment attributable to UAE PE of a foreign company. Now, in this particular respect, there are certain examples also that have been given of what will be specific source income. We will just discuss that as well. Payment attributable, and of course, needless to mention that because there's an India-UAE tax treaty, therefore, all the taxability that we are discussing is subject to the specific provision of that particular treaty. Payment attributable to UAE PE of a foreign company, in this case, the foreign company is the Indian company. And this is the one which is the broadest one. Income accrued in or derived from activities. So if you are conducting any activities in the UAE and you're getting that income, the activities may be performed directly by the person or through another person. Contract performed in the UAE, assets located in the UAE. Assets can be something like an immovable property or a movable property. Capital invested, which means if you are owning the shares of a UAE company, rights used. So if a person has certain intangible assets or intangible rights, and it allows the use of that right to a UAE company, and in exchange, they receive certain money or services performed or benefited from in the state, in the UAE. Now, if you look at it broadly, this would cover large number of forms of income earned by a non-resident. Let's look at some of the examples that are there in this context. But before that, like I mentioned, these are some of the resources that we have where you can just go and study more about UAE corporate tax. There's a UAE corporate tax resource page that we just saw a little while ago. We've got a LinkedIn page on the request of a lot of group members that we had. We've got close to 1,000 group members on the UAE corporate tax group on LinkedIn. You can feel free to join it. The link for that is here. But on a request of a lot of people that, it is much, much more easier for them to maybe interact on the page. We actually created a page last week. So you can also like that particular page. The link is given in the description here. And of course, all this culminates into our UAE corporate tax course, which has been updated to I would say, around 6 to 7 chapters have already been updated based on the new law. And we do expect that within the next 1 or 2 weeks, we will be able to upload more or less a large part of the new corporate tax law, a course which is completely up to date on this particular aspect. And believe me, these resources aside, the concepts that have been put into the UAE corporate tax law are par at any other country in the world. They are much, much more simpler, but they do cover almost all the aspects relating to the taxation, relating to deductibility, relating to foreign taxation, particularly for foreign taxation. The concept of permanent establishment has been defined quite clearly now within the law. It is quite detailed. For transfer pricing, there is a lot of things you have to maintain: master file and local file, if you believe that you're meeting the arm's length criteria. And there is advanced pricing agreement also. So there are a lot of these things which are incorporated in the new law that we would be covering as a part of our corporate tax courses. Transfer pricing is something which has already been completed, so that also will go live shortly. Now, some of the examples that you have for UAE sourced income is as under, which is income from sale of goods in the UAE. So if a foreign company is selling some goods to a person in the UAE, that will be treated as UAE sourced income. Now, there's a difference between UAE sourced income and income taxable in the UAE. UAE sourced income will be something which can be taxable, but there may be further conditions attached to this, like a permanent establishment in case of business. Because let's say, I'll just take one example to explain this concept. Suppose a foreign company sells goods to a UAE person. It is treated as UAE sourced income. But if they do not have a PE in the UAE, whether through a fixed place of business, which is included in the UAE corporate tax law, or agency business, which is again included in the UAE corporate tax law, then even if this is considered as a state-sourced income, it will not be liable to tax. Therefore, just because of the fact that one income constitutes a state-sourced income does not mean that it is liable to tax in the UAE. Income from provision of services that are rendered or utilized or benefited from in the state. So if you provide services in the state, or you provide services from outside UAE, but they are utilized in the UAE or benefited from in the UAE, they will be liable to UAE corporate tax. Income from a contract, insofar it has been wholly or partly performed or benefited from in the state. So if there is a particular contract where there is a split of people working both in and outside UAE, then that will amount to wholly or partly performed in the UAE. If it is done completely here, wholly performed in UAE. If it is done partly here, partly performed in UAE. Then in that case, that income will be liable to tax in the UAE. Income from movable or immovable property in the state. This could be in the form of rental from leased properties and movable assets. Income from disposal of shares or capital of a resident person. So if an Indian company has a subsidiary in the UAE and they sell the shares of this subsidiary, or for that matter, if there's a listed company and the Indian company sells the shares of that listed company, the income from such a disposal will also be liable to, or will also be considered as state source income. Interest income, there are conditions as to the security that has been provided against interest, but interest income earned by a non-resident may also be considered as a state source income. Income from use or right to use in the state, or grant of permission to use in the state any intellectual or intangible property. We discussed this. We'll also see an example on this, or insurance or reinsurance premium earned by a foreign non-resident from the UAE. Let's look at some more examples around this. We'll just take a 1-minute break here. So we don't have any questions as of now, but if there are any questions, you can just drop them in the comment section. So when we talk about UAE sourced income, where an Indian company sells certain goods to a UAE mainland entity, the income from this sale of goods will be considered as UAE sourced income. Now, if this company has a permanent establishment here, if let's say this is a business profit and it has a permanent establishment, then this will be taxable in UAE. But if it does not have a permanent establishment, then this will not be taxable in the UAE. Payment attributable to UAE of a foreign company. Now, suppose Indian company has a permanent establishment in the UAE. And this PE provides certain services to a foreign company for which it receives this income, the service fees. So services are provided and service fees is received. Now, payment attributable to UAE of a foreign company. So this payment is basically attributable to UAE of an Indian company, and therefore UAE will have the right to tax this income. Activities or contracts performed in the UAE. Now, in this particular example, we have an Indian company which is providing certain services to ABC UAE. And to provide these services, it has sent certain employees which stay in a hotel. So this is an income from activities performed in the UAE and therefore will be considered as UAE sourced income. Now, the taxability will differ, of course, depending on whether it's considered as a service income or a business income, and the existence or otherwise of the PE in light of the provisions of the India-UAE treaty. But yes, this will be considered as UAE sourced income. Free zone entities. Now, why we are covering free zone entities as a part of today's webinar is that a lot of Indian companies actually have free zone subsidiaries. And, interestingly, I was looking at one of the free zone, the numbers that were there in one of the free zones. And it just turned out that around 30% of the companies in that free zone had Indian parents. So when we talk about free zone persons, the entities that are covered are twofold. One is companies which are registered in a free zone, and second is branches which are registered in a free zone. Now, it might sound a little strange, but there is an option under the UAE corporate tax law whereby a free zone person can elect to be subjected to normal corporate tax rate. Now, some people might be thinking why this is there, but the root for this lies in the fact that in many cases, what happens is certain payments, let's say to a low tax jurisdiction, that is where the tax rate is lower than a particular threshold, are subject to a higher withholding tax. For example, suppose an Indian company were to make a payment to a UAE entity, and the free zone entity in the UAE enjoys 0% corporate tax. What is going to happen is that, I'm not saying not necessarily for India, but what happens in these cases is that when these companies make payment to a UAE entity, if this entity is suffering tax below a particular threshold, then they withhold tax, deduct TDS at a high rate. Now think of a situation where the TDS to be deducted here is 10%. But because this company is not taxable, suddenly the TDS rate goes to 20%. Now, deducting 20% tax here and losing it out is not something which would make sense if by paying 9% here, you can actually reduce this to 10% or maybe even 0%. So wherever the withholding tax arbitrage is high compared to the 9% corporate tax rate that has to be paid, foreign companies are likely to structure this and elect to pay corporate tax in respect of the free zone entities. Now, a free zone person, when we talk about their taxability, it can be a qualifying free zone person. For that, the definition is given in Article 18. If the person meets the condition of being a qualifying free zone person, the income tax rate will be 0% on the qualifying income. Whereas, if they do not qualify as a qualifying free zone person, they will be taxable both in respect of a non-qualifying free zone person, which is 9%. And even if a person is qualifying free zone person, but the income that they earn is non-qualifying income, that will also be subject to 9% corporate tax rate. Now, who is a qualifying free zone person under the UAE corporate tax law? The first condition for being a qualifying free zone person is that you should have economic substance or substance in the UAE. Now, as of now, the criteria of being, having substance in UAE is met through the economic substance regulations. So whatever substance regulations are there, according to them, if you are maintaining adequate substance in the UAE, you will be considered as a qualifying free zone person, provided you meet the other conditions as well. Now, if you need any assistance in terms of evaluating whether you are qualifying as a free zone person in the UAE, we will be glad to assist you. There are again various resources on our website on economic substance regulation that you can refer to. The second is the income that this person, the free zone person, is getting should be qualifying income. Now, as of now, which specific income will fall under qualifying income is not given. We've taken a few examples based on the example given in the public consultation document, but this is obviously subject to the further clarification that may come. Third is that this person should not have elected to be taxed under the UAE corporate tax, the one that we just spoke in the preceding slide. And fourth one is they comply with the arm's length pricing and the transfer pricing requirements. Now, this is very, very important because most of the free zone companies are likely to have transactions with related parties. And therefore, it becomes very, very important for you to benchmark your transactions, both for related parties, as well as there's a concept of connected person under the UAE corporate tax law. So all these transactions would need to be benchmarked. And that is something which, you can always reach out to us if you need any assistance on this benchmarking. However, if a qualifying free zone person fails to meet the conditions of Article 18(1) in a subsequent year, so you meet the condition in 1 year, you get the exemption. In year 2, let's say if you don't meet the condition, then in that case, what is going to happen is that you will have to pay taxes. Now, like I mentioned, the definition of qualifying income is something which is interrelated in the current tax law. But when you had the public consultation document, some references were given, some examples were given, not necessarily that in the final analysis, these are going to get included, but export of services by a free zone entity to an overseas entity was considered as outside the purview of taxability. Similarly, sale of goods to another foreign recipient was also exempt from UAE corporate tax. So maybe these might just qualify as qualifying free zone income. Provision of services within the same free zone by one free zone entity to another free zone entity. So let's say if the Indian entity has some free zone entities overseas and it is providing services to another free zone entity, that was considered exempt, or to another entity in a different free zone. Income from mainland branch. So under the earlier law as well, there was a provision that this income would be considered as taxable for the free zone entity. The chances are that this may again not be considered as qualifying free income subject to 0% corporate tax. Let's briefly touch upon the concept of PE as given in Article 14. Now, the importance of PE is that there has to be, it kind of emulates that there is a sufficient presence of the Indian company in UAE to warrant taxation of business profits in the UAE. The forms of PE under the proposed UAE corporate tax law includes fixed place PE, agency PE, that is where an agent has an authority to conclude contracts, but independent agent is something which is excluded. Fixed place PE, again, there are examples given that an office or a workspace, etc., would constitute fixed place PE. And there's also a mention that, if there's a specified nexus in the UAE, that may also constitute permanent establishment. So like I mentioned, Article 14 basically gives examples of fixed place PE. It gives exclusion from PE. So this is again, what I should say, those preliminary activities which you have in Article 5, they are the ones that have been excluded. However, from a preliminary activity, what they've mentioned is that if there is a particular place which you are claiming to be exempt because they are preliminary, but from the same place you carry out other business activity, either yourself or another related party does some activity, then this will lose this exemption. Now, this is quite an interesting but a very, very practical point that has been added in the Article 14 that we have. Then independent agent will not constitute PE, and exclusion of individual activities from constituting PE. I think these two examples we've already discussed, so I would just skip them. Yeah, so this is again one of the important criteria that are there, which is that there are many business travelers who travel to UAE and who basically enter into contracts with local people. The question is, will a PE arise in such a case? Now, a business traveler who is acting on behalf of a foreign company in the UAE or exercising an authority to conclude contract can constitute a dependent agent PE. But what is specifically given in Article 14 is that temporary situations or exceptional situations where non-core income generating activities are done in the UAE and the foreign company does not have any state source income out of these activities will not result in a permanent establishment in the UAE. These are some procedural issues. If, let's say, for example, if you have one of your subsidiaries over in the UAE, then if you can choose to become a tax group, then a single tax return is required to be filed. Tax group is a concept where more than one entities might be there in the UAE with a common parent. And there are, again, conditions relating to the ownership, etc. But if those conditions are met, all these four companies can together form a tax group and the parent can file a single return. The tax has to be paid within 9 months from the end of the relevant tax period. And the tax return is also required to be filed within 9 months from the end of the tax period. This period can be modified because the provision mentioned that 9 months or any other period specified. Now, this is again one of the common questions which has come across to us since the law has been released, and a lot of our clients and people have asked us this question as to what is the requirement to prepare financial statement, right? So the way it seems as of now is that there is a mention that the FTA may require a taxable person to provide financial statement used as a basis to prepare ITR. What that implies is that if they need to require them, then submitting them along with the ITR may not be a mandatory requirement. Now, this may change because the tax procedure law will also be added. And second is that it can also issue directions to the effect that audit has to be carried out by certain specified act person, or the financial statement have to be certified in certain cases. Not all the cases, but certain specific cases. Again, let's move on to the next slide, which is around transfer pricing. Now, this is again going to be one of the areas where there will be a lot of, I would say, efforts which will be involved both from a company perspective as well as the consultant perspective. So under the UAE corporate law, transactions with related party or connected person will be considered as being covered for transfer pricing, which need to meet the arm's length criteria. So while there are several situations where two or more people can qualify as related person, we have detailed each one of them individually in our UAE corporate tax course. And for those of you who are already enrolled in the course, of course, you can go back to that particular module, which should be uploaded, I guess, by today or tomorrow. And when you go there, you will be able to find out all the possible scenarios where two people can be related parties. Because for the paucity of time, we cannot cover all of them here. We will just cover them briefly. So two or more natural persons, that is individuals, can qualify as related parties where they are related through kinship to the fourth degree. That is, fourth degree of kinship is something which is covered. So let's say if A is related to B, is related to C, is related to D, even these can be related party as long as they have kinship amongst each other. Second is a natural person and juridical person, that is an individual and a company, can also be related party. Here, the criteria is that of control and ownership. So if the individual exercises control over the company, then basically they will be related party. So let's say if an individual in India owns a company in UAE, right? Then the two will be related party by the virtue of the shareholding criteria. For shareholding, the limit is 50% or more. So if the natural person is more than 50% in this juridical person, the two will be related parties. Two or more juridical person, this would be a case where, let's say, company 1 owns 50% or greater interest in company 2. The two will be related party. If company 1 owes greater than 50% in company 2 and company 3, even company 2 and company 3 will be related party. Where ownership criteria is not met, but there is a common person who exercises control over these two entities, they will be related parties. Or if this person exercises control here, they will be related parties. If you need to assess the impact of UAE corporate tax on your business or relating to the transfer pricing, we will be more than happy to help you out with that. So with that, we come to an end of the session today. I hope it was an informative one. The law is still new. There are a lot of changes, a lot of things which are there. While, it's a 60-70 page document that is there as a law. Given the nature of transaction, the way business operates, there can be hundreds and thousands of implications on each one of them. It's not possible to cover all of them in a short span of time of 1 hour, but we will be for sure conducting more such sessions. And if you want regular access to all this information, all these videos, webinars, and everything, you can be a part of our UAE corporate tax course, where you can just access them anytime, anywhere. The details for the course are something which is going to be there in the webinar. Like I mentioned, we have completed a good amount of the update part of the UAE corporate tax as we are taking this webinar. And within a span of next few weeks, you will have the complete updated course with you. And whenever you feel like, you can please join that particular course. If there are any queries, you can please leave them in the Dropbox. I'll also just check for the benefit of everyone if there's any questions. No, it seems there are no further questions which are there. And even if after the webinar you want to place any questions that you want us to answer, you can feel free to write them here, and we will be more than happy to address them. Yeah. So thank you for being with us today. If you want to join our mailing list, you can just drop an email to contact@sortingtax.com, and we will be sending you regular updates, etc., whatever we are preparing, and sharing it with you. Of course, if you are connected with us on our page, then or group, that information would in any case keep on coming down to you. But this is also something we'll be happy to deal with. So with that, we would end the webinar for today.